Good morning, good afternoon, everyone. This is Rob Barnett from Bloomberg Intelligence, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. Very much apologize for some of the technical difficulties here today, but we're on site at Bloomberg's. You can just see it over my shoulder here, but our Farm Food and Fuel Summit in Kansas City. Brett Gibbs is here with me. He's one of our analysts who looks after not just biofuels, but refining, a number of the oil and gas sort of companies out there. And so uh, I, I think today it's just going to be the two of us, and we're going to do our best to hopefully avoid any additional technical difficulties and also give you a sense of the kind of things that are being discussed here at the conference. And so I think big picture, I'm curious from you, Brett, because you've given 5 or 6 presentations here. Too many, in my humble opinion. I would have been overwhelmed, wouldn't have known how to sort of get all the content together like you've done. But when you think about the biofuel space in particular right now in North America, is it a good time to be in the business? Are companies making money? Which parts of the value chain are the ones that are most lucrative here at the moment?
No, absolutely. So our initial kind of setup in series this week has been, we did a policy, then we broke into an ethanol session, renewable diesel session yesterday. We have a feedstock session coming up. And kind of the big call that we had was essentially policy in the US from a biofuels perspective impose a little bit of a speed limit here through the 2025 stretch with the latest federal policy, which we in the industry refer to as kind of the set rule. So it was the first of its kind that we now had 3 years of guidance from a mandate or kind of where volumes need to be under these federal programs. And so the industry has kind of adjusted to that, kind of run supply and demand models against it. And it looks overwhelmingly that during 2024, for instance, there's a stretch of oversupply. And so that's kind of where the industry is looking at. You've seen the biofuel credit prices, RINs that we refer to, come off pretty substantially. Renewable diesel margins have gone from $2.25 a gallon down to $1.25 a gallon, even further below that. And the big shift, though, and where the industry is looking is there's some policy changes coming in 2025 with a tax credit shift. So within the IRA, there was a tax credit imposed called 45Z, and it's the replacement or new version of a legacy blender's tax credit. And the blender's tax credit was a flat $1 a gallon for anything biomass-based diesel, as long as it was blended within the US. So it didn't matter about feedstocks. 45Z, however, is fuel agnostic. So no longer is it just biomass-based diesel. There's also opportunities for ethanol. But within that policy shift as well is now you have a carbon emissions-based factor onto this. So you have incentive to run the lowest carbon feedstocks. And similarly, there's a clause in it that it's no longer blended in the US. It has to be produced in the US. So that's a shift that I think the industry is trying to digest, and a lot of our conversation this week has been on.
You know, one of the things that struck me as surprising, only following the biofuel space at very much arm's length, is the amount of impact that the LCFS in California has had. And you had a great chart yesterday showing the amount of renewable diesel that was being deployed in the state. And I'm curious, is the, first of all, let everyone know kind of where we're at today on that front in California, and do you see that spreading to other states, other geographies, and how's that LCFS playing into this overall conversation?
Yeah, so California was kind of the pioneer of all this. They were the first to introduce the state-based clean fuels program back in 2011. And now the latest quarter of data, renewable diesel is upwards of 48% of the diesel pool mix. And when you stack in biodiesel and you look at an aggregate, the amount of California's diesel pool that's biomass based, it's in excess of 50%. And so the thought is a lot of renewable fuels producers, essentially their goal is to maximize and stack credits, because in order to essentially generate the margin that they're after with converting some of these feedstocks into fuel, right, they sell at parity to their petroleum counterpart, right? So it's the feedstocks versus diesel, and how the companies make margin is essentially stacking some of these credits. And so because at the time, California was the pioneer, they had an incremental incentive, a lot of the product flew and kind of went to the California market. Now, since we've seen some more states following California's shoes, the first of which was Oregon, Washington, and most recently passed in New Mexico. And the thought, though, is more and more product flows will go into those regions. And the interesting thing about the clean fuel standard or the state-based programs is the credits don't expire. So you essentially build this long-term bank. And as more and more states go on, you could see product flow just shift to that region for wherever the highest price of carbon is. And so we had a chart yesterday that kind of stacked those 4 states against, diesel in those states and overall renewable diesel, biodiesel production, and it's still very, very small and fractional. So we think that as more states come online, it'll quickly flow to those markets, and it'll be a very similar story to kind of California's ramp up. The interesting thing with renewable diesel is it's chemically identical to diesel. There's no blending restrictions, so that's the area that it really displaces a lot of the diesel pool. Biodiesel is typically sold in 5% or 20% blends, so renewable diesel has been what's displacing a lot of petroleum-based diesel.
It strikes me that California has done something that's very good for farmers in the Midwest, and I kind of find that to be sort of an interesting policy outcome. I'm curious if it's the LCFS, some of the other policies, is that what drove kind of Chevron's interest with Renewable Energy Group, or sort of the traditional oil patch getting more into biofuels? How do you see that evolution that's been occurring?
Yeah, it was an interesting timing, right? Well, we had a chart too yesterday talking about the evolution of renewable diesel, the peer group, the market size. And back in 2019, the capacity in the US was about 37,000 barrels a day of renewable diesel. Now we're in excess of 200,000 barrels a day. And the entrants since then are very heavily skewed to the petroleum folks. And so when I look at that, right, we think about where refiners, the integrated oils were back in 2020 and 2021, right? Refining margins were much lower than they are today. Environmental credit costs were also very, very high. And so when we were looking at it and the industry was looking at how do you rationalize some of the marginal refining assets that were struggling, a lot of them looked to conversions for renewable diesel. And the thought for it then was, we are, in a lot of senses, the obligated parties in a lot of these schemes, right, in California under the RFS. And this was an opportunity to, hey, if it's going into the fuels mix, displacing some of the petroleum-based, having a role into that. So that's the shift there. The interesting part now is the approach and perspective of some of these entrants, your refiners, your integrated oils, of being able to weather a low margin environment is way different than your pure biofuels focused folks who don't have the balance sheet strength. They don't have the diversified earnings bases. These folks, call it your Chevron who bought Renewable Energy Group, or some of your larger refiners like Valero, Marathon entering the space. Part of them can endure much lower margins that the industry got accustomed to.
Yeah, very, very fascinating. Maybe to pivot a little bit and talk more macro on sort of the biofuel space, because I think one theme that you've kind of heard here at the event is, well, in the light duty space, EVs are gaining traction, and they do appear to be growing fast. We're a long way from 100% EV sales, but I think the idea here is that on the margin, if you have increasing electric vehicle penetration, that potentially crowds out demand for biofuels. And so how do you think about that sort of switch that seems to be underway in the light duty fleet, and what's it mean for kind of that medium and longer term demand picture for biofuels?
Absolutely. And I think you had a great conversation yesterday with Jeff Cooper from RFA on it. And so the first of which, right, is looking at gasoline demand as it being the first area of electrification to displace some of the fuel demand and biofuels availability, right? And so we're tracking that gasoline blending or ethanol blending into the gasoline pool has really found a resistance level at about the 10 and a half times the gasoline pool. They're trying to push E15 as a means to compensate for some of this. But it is very, very heavily bound to gasoline. So that's one of the big inherent threats to it. And where you're seeing a lot of the corn-based ethanol, RFA's ambitions and focus is shifting to, hey, we have 18 billion gallons of ethanol capacity in the US. It's about 40% of the US corn crop goes to ethanol here. There's the infrastructure, that sort of thing. How do we then transition it to the more hard to abate sectors that really need clean fuels and the ag-based crops? And the first of which now is looking at ethanol as a pathway into sustainable aviation fuel. And really what the industry is waiting on here is this life cycle emission modeling that is originally scheduled to be late last year, then March. We're still awaiting that now. And that's essentially the green light, or hopefully the green light that the industry is waiting on to understand, hey, do we have a pathway? Can we compete here? And really you can convert a gallon of ethanol or 1.7 gallons of ethanol into a gallon of sustainable aviation fuel. So when you think about it, big picture, right, we have about 18 billion gallons, 17 billion gallons. That's the equivalent of 10 billion gallons of sustainable aviation fuel. So when you think about the SAF Grand Challenge, again, there's not a mandate here in the US yet, but the agenda is to get to 3 billion gallons by 2030, eventually scale up to the full jet pool, which is 35 billion gallons. From a scalability side, a lot of folks have been looking at ethanol as a means to bridge some of that.
Those are some very interesting stats. I'm curious from a technological perspective that that ratio you mentioned going from 1.7 to 1 from ethanol to sustainable aviation fuel. Is it technically difficult? Does it require CapEx? How hard would it be to take the existing infrastructure and move it away from kind of light duty ethanol over to SAF?
So 1.7 conversion is really due to a energy density perspective. So when you think about it, even on ethanol versus gasoline, ethanol has about 70% of the energy density of gasoline. So right, when you look at gasoline prices on a per gallon basis, it's a little bit skewed, but the conversion uplift is essentially taking the ethanol energy density and getting it into the distillate cut or the jet cut is about 1.7 times. And from an infrastructure side, it's more developing or merging than call it your hydroprocessing, which is the legacy fats, oil, and greases into renewable diesel or SAF. But it is reaching the commercial scale. We just had earlier this year, LanzaJet started up a plant in Georgia, the first of its kind of an ethanol to jet production plant. The thing, though, that's interesting about it is right now, because of the carbon intensity restrictions, to receive some of this credits, they're relying on ethanol from other regions that have a low carbon intensity score, right? So a lot of it here is, are we going to reach and receive the amount of credits where it makes economic sense to start deploying it? So when we look out to 2030 of project announcements, our colleagues at Bloomberg NEF actually do a great chart of having this. You still see a very limited amount of ethanol to jet plants. And a lot of it is because in order to underwrite, finance some of these projects, they need to understand the economics of it. And so the thought is, once we hear from this tax credit scheme, if it is supportive, there are folks waiting to deploy capital in the space.
Yeah, very interesting. So our group here that regularly attends these calls is pretty international. And so I think there are some things happening in the US that are sort of quite specific. And I don't want to get too technical on, say, the Greek model or whatever, but can you explain just at the highest level kind of how the life cycle analysis works and how it feeds into the economics, just as someone who's only following the oil and gas market at sort of the 30,000 foot level has a little bit of appreciation for this aspect of what's going on in the US.
Absolutely. And a lot of the modeling too is still getting worked out of all of these tax credits globally are deferring to these different life cycle modeling tools. And so in Europe, one of the ones that was commonly referred to was this Porsche-based modeling. And really at its core, where it goes back to is Argonne National Laboratory in Washington here in the US developed this mechanism to measure life cycle emissions end to end. And a lot of the back and forth or kind of sticking grounds between some of this is what are the inputs to that? How do we feed it? How do we assess all the way back to the acreage and the crops and what they're using, what type of fertilizers, what type of equipment they're using, and how do they assess, well, how do we assign a carbon score to this at the end of it? So that's really where the industry is evolving, and all the tax credits have gone to this. But as more money and tax credits are dependent on it, you're seeing more folks push to say, well, we need to really figure out what's going into the inputs, the modeling of all of this sort of thing. But at a high level, it's trying to assess at its core where we're not displacing land, we're using the most efficient energy sources to provide a feedstock that once it gets to the consumer is the lowest carbon possible. And across all of them, it really favors the waste-based feedstocks. So for renewable diesel, for instance, it's your animal fats, your tallows, your used cooking oils that you fry and dispose. And now all of this is kind of creating incentives throughout these programs to award producers more money for that. And that's the shift. And with this tax credit, it's again for US produced fuels. So it has to be produced in the US, but there's no clause on where the feedstock is coming from. So that's one of the intrigue too of where can we pull and source feedstocks in different parts of the world to get it here.
Okay, very interesting. I'm curious to hear some thoughts from you on just some of the bigger picture criticisms of, say, biofuels. And I think I know the sort of general view from folks here in the room, very farm, ag oriented, but there is this food versus fuel debate that has always persisted in the context of biofuels and ethanol because a fairly large portion of our corn production goes into fuel. So can you sort of roughly touch on the sort of amount or the volume of corn and soy that go into biofuel production? And, is there any concern that this is chipping away from food supply, or is this all sort of healthy and balanced and working out? What do you make of that sort of piece of the debate?
Yeah, it's definitely something that you within the space here frequently policymakers have to try and balance into it in setting their regulations. From a corn side of it, about 40% now of U.S. based corn crop goes to ethanol. So one of the things, right? Yes, the food implications there. It also is important to look at how yields on the ag side have evolved in time, right? So even that the acreages may be the same, the amount that we're able to get out of per acre is slightly different. Within the soy side into biomass-based fuels, it's important to think about it, right? Because it's not necessarily soy itself that is going into renewable fuels, it's soy that's crushed. And then we have the meal portion and the oil portion. And the oil portion is much smaller than the meal. So call it like 20 or so percent of what you crush. And this past year, about 48% of US soybean oil went to renewable fuel. So it definitely has a pull. But the implications too are essentially within the fuels. I think a lot of more of the pushback in assessing a lot of this when it came to the renewable fuel standard in the 2023 to 2025 RVO was the fuel prices at the time, because a lot of times what is also not thought about is who are the people paying and incentivizing this. So within the renewable fuel standard, it's a pass through. The thought is the refiners and importers of the fuels who have to pay more, subsidize some of this, pass that on to consumers too. And so when gas prices are, $3 and, half dollars, $4 a gallon in the US, it's very, very tough politically to create a program that is incentivizing more renewable fuels, that is then pushing these credits up to subsidize some of it. So I think, yes, the food versus fuel debate gets a lot of it, but there's much more behind the story there.
Okay, that's very interesting. And there's a cool chart. I'll try to share it when we post the replay that Jason Miner, who's our head of the ag research within Bloomberg Intelligence, and it just shows the yield on corn, and it's this incredible, relatively linear chart every year that just farmers get better and better at producing more corn with the same amount of land. And I think that this is a fascinating outcome for humanity. It kind of reminds me a little bit of the shale revolution. It just, agriculture, one of the oldest businesses, energy's been around a long time, and we're continuing to see innovation. And here at the event, there's actually been a lot of talk about applying AI and automation technology to the farming industry. And I'm curious that if these technologies get deployed, are we going to see yields improve even more? And how do you think that's going to feed into that sort of longer term debate around biofuels?
Yeah, no, I think it's a great question. And you brought up the perfect chart to explain it, right, of how it's evolved. And I think that continues, right? And the even more interesting thing from the tech side within ag is essentially how you can look at regenerative agriculture and become more efficient on your per acre basis, both on yield, but also with energy use and with fertilizer use and all that sort of stuff. And under these programs, there could become economic incentives from a carbon perspective to do so. And I think that could make the ag space a little bit more competitive, more broadly within the renewable fuels, right? If the fight and incentive is to get the lowest carbon fuel per gallon, whatever that may be, there's also the tech on the side within ag of finding ways to reduce your CO2 there to become more competitive and maybe displace yourself a little bit from the, kind of food versus fuel debate there.
All right. Well, given that we are here at the event, and I know we've both got to run to a session, we're going to keep this a little shorter than we normally do with these calls. But uh, I'm really thrilled that we got to hang out here at the event. We're trying to share a little bit of the sort of discussion here with the online group that knows us in terms of our research from the energy space. And I would just encourage you to monitor these calls, chat with Brett or I. We're trying to sort of not just be faces on a screen. We do hold plenty of in-person events, and so keep tabs on that. We'd love to see you in person at some point and welcome you to whether it's Kansas City, New York, Miami, on down the line. We like to see you in person. And yeah, thanks for your time today, and we look forward to being in touch.
Yeah, thanks, Rob.
Cheers. Bye, everyone.